Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. He is Evan Barnard hanging out here with me. Okay, so the thing we got into is we were just talking a little bit about investing markets. We were talking about how markets work. We were talking about some of the misinformation that is out there. But I actually said, hey, why don't we do this? Let's just go throw up on there on the website a link to, you can get the couple books that I've written on these topics. So what we basically did is put on there, and it was kind of a 2-for-1 thing, where we put paulwinkler.com/books, and you can get the investing book that I have, Confident Investing, along with a new book that I've got on taking income in retirement and the myths about taking income in retirement. So it's on there, paulwinkler.com/books. But that led to a discussion. We were talking about how often annuities are marketed as an income source,
right?
In retirement.
Yeah.
So I came in and to the office the next day, and I said, Brian, Mr. Excel man. Brian is great with Excel in our office here.
None of us actually have a social life in the whole firm.
That's true. You guys don't.
Excel, taxes.
That's what I love about you.
We're really exciting
You're just
people.
all nerds. It's just it's really great. But I said, can you run? I said, I want you to take a 65-year-old female, and I want you to run what would happen if a 65-year-old female gave $500,000 to an insurance company and just took an income off of that, for life. How much income would they be getting? But I want you to do a little twist. I said, I would like you to take that amount of income, and I want you to take it forward, get her to age 90, because her life, she certainly could live that long, easily. If you take a joint life expectancy of a couple, age 65, it's like jointly life expectancy of 94 or something like that.
Yeah,
I think it's somewhere
Close.
in that neighborhood. So we're not talking out of turn here by any stretch of the imagination. I said, so take that. And I said, because it has a nice even break of when I started the company in the year just before the year 2000 until now. So he comes out and he says, okay, an insurance company, and he just went to immediateannuities.com, they would pay $37,356. Now, somebody selling that would go, hey, look, $500,000, $37,000 guaranteed income, as long as the insurance company doesn't go under.
Right.
You've got guaranteed income for life. And, what's not to like about that? Well, the problem that you run into is that you don't have a cost of living increase built into this thing. So I said, just take the CPI, the Consumer Price Index, and from 2000 through 2024, what would the purchasing power become if you annuitized it? Now, by the way, most people don't annuitize it because they don't like losing control of their money. But how much would the purchasing power go down? And the answer was the purchasing power would go to about 1/2 over that period of time.
Yeah, so, about 3%. That makes sense, yeah.
Yeah, so you lose about half of your purchasing power over that period of time. Then what I did is this. I said, now I want you to look at the previous 25-year period, just for the fun of it. How long would it take to go to half of purchasing power? The answer was 9 years. 9 years, and literally only 9 years, your purchasing power of that $37,000 drops to about $20,000.
Because you started in what, 65? What?
75.
75 was the second one?
Yes, the second one.
Okay, yeah.
So I was just looking at 2 25-year periods.
Yeah.
Because we don't know what's going to happen going forward.
Right.
So I said, why don't we just do that? Now, what is it at the end of 25 years, your purchasing power? Answer, it is about $10,000. So you're literally at 1/4 of what you started with. So you think about that, and you might look at something like that and go, hey, this is great. This is wonderful. It's security in retirement.
Mm-hmm.
And my point is that real security? Because once you annuitize like that, you've lost access to the money too.
Right.
I mean, basically, you've signed up. You've seen these commercials.
Which is why people don't do it. I mean,
right.
Like you said, people don't like to turn loose of that control.
Well, you see the settlement commercials. Used to anyway.
Oh, the viatical settlements and all?
Well, no, just regular settlements. Like, let's say if you've got a stream of income coming in, they had the attorneys.
Yeah, like a Peachtree Financial or something like that.
Yeah, whatever they were. I don't remember the names
yeah.
of the companies,
Yeah.
but they would say you can actually turn it back into cash again.
Yeah.
We'll receive your income streams.
Yep, yeah.
But you take it on the chin when you do that.
Yeah.
Because they're not going to do that for free.
They don't have big buildings because they can't do math.
That's right. That's right. Yeah, that's exactly right. So, to me, I thought that was a little bit eye-opening, So,
Yeah.
Evan, what do you got?
I had a couple of things. One is actually just an admin note.
Mm-hmm.
And either I had missed the news or it just kind of snuck by me. But there's been a modification. I guess the IRS finally clarified some rules on high earners, age 50 and older, are about to lose a major 401k tax break.
Are you? So you're talking about that we have to go to Roth?
Yeah.
Yeah. Ugh, yeah.
And I don't know if you talked about that last week or not.
I know I did
yeah.
not. I did not. It's been a while since I talked about it. I knew it was coming.
If you're over 50, you have
Yeah.
this catch-up provision in 401ks, just like you do in IRAs and so forth. And previously, you could do that pre-tax. And now, this is the first time that the government has mandated a Roth contribution. And
Got to pay taxes now at your higher level, at your higher income tax bracket.
Yeah, so it's an interesting deal.
Oh, it is. It's so explain that to them because people may not be know. So you got $10,000
Yeah, so
of contributions.
If
use that as an example.
Let's just say you're in the 24% tax bracket. I wish it was 20. I wish it was 25.
Go 37 because it might be because a lot of those people. Well, 24
I mean,
are higher.
as if you're making over 154, you're subject to this rule, and that still keeps you.
Yeah, that keeps you at 24.
If you're married,
sure,
that keeps you lower.
Yeah, true.
But so let's say 24, just because it makes the math easy. But it's close to 25. And
True.
so if you were adding $10,000 pre-tax into your 401k as a catch-up contribution, you would reduce your tax liability by $2,400. And, so that's great. You pay less tax, and as is typically the case, when you retire, you're in a lower effective rate anyway. And so now you can't put that $10,000 in pre-tax. You've got to put it in the Roth bucket. Now, that Roth bucket is growing tax-free, so it's not like they totally pulled the rug out from under you.
Right.
But they're forcing you to do an after-tax contribution for catch-up. That's an interesting twist. That's the first time they've ever done that.
Yeah, that's what always got me about. It used to be that you had to have an income of below $100,000, $100,000 or lower to do any kind of a conversion to a Roth IRA. And I always thought that was the funniest thing. You got to have an income that's lower than this to do a Roth conversion. And then the government goes, oh, wait a minute. If we let people with incomes above $100,000 do Roth IRA conversions, we'll get tax money today. And,
Right.
so it behooved the government to not have a cap on Roth conversions.
Yeah.
And now what they're doing is they're saying not only is it just, it's not just an optional thing that you can go and pay taxes at those higher rates, you've got to. And it's just like, oh.
Yeah, now the interesting thing for me,
Yeah.
when you think about unintended consequences, theoretically that money's got to sit there and doesn't even really start the Roth IRA clock because it's still a Roth 401k. But if the government is mandating you putting money in this account and say you retire in 3 years, are they saying you still can't get access to this money, tax-free because, the government mandated it? I mean,
you'll always get the basis, and in over 3 years, probably most of that money's going to be basis anyway. So
yes.
I don't know that it's a big a deal.
I just think it's,
I know it is kind of that's a nerdy point you're making.
Onion.
It is a very nerdy point you're making. That's interesting. So if you want to spend it all, you can, right? That's interesting. So to me, it is frustrating, but I can see why they're doing it because they are strapped.
Oh
for
yeah,
cash.
they want the money.
Yeah, they're strapped for cash. No question about it. The Austin Goolsbee.
Oh, yeah.
Chicago.
Boy, I haven't heard that name for a little while.
Well, he comes on CNBC from time to time.
Uh-huh.
He was a Fed president of the Federal Reserve in Chicago. And I just always thought it was interesting because he never had an issue getting into his politics back before he was Fed president.
Yeah.
And now he's paranoid
Well, he
about
was a
talking.
big Obama guy.
Oh yeah, he was a big Obama guy.
Yeah.
Yeah, but he's paranoid talking about anything political. Well, he was
Maybe
on.
he's up for the job.
Yeah, I don't know. Well, he was really big on making sure that you recognize that you never speak for another Fed governor. You never speak for anybody else in the Federal Reserve. But I thought it was interesting him talking about the Fed independence because that's been talked about a lot in the news. Why there was no market crash. Why we haven't had any kind of a market crash because of the issue with Fed independence and with Trump seeming to try to have some control regarding the Federal Reserve and their policies. But this is what he had to say about that.
Hey, Austin, I've got a different question for you. For a long time, folks in your position and others have talked about the independence of the Fed and suggested that if the independence of the Fed were put into question, the bond market would react, that the stock market would react, that it would have a demonstrably deleterious effect. Why has that not happened?
Deleterious. I like what you did there.
Why has that not happened?
Alliteration.
I don't know. You definitely don't want to get in the head of this. It's forbidden to try to get in the head of the other members of the FOMC, and it's very difficult to get into the head all the time of the market. But I will say, I absolutely believe that if you look at other countries or if you look at times in the United States when there is not monetary independence from political interference when setting the interest rate, inflation comes back, the unemployment rate is worse, job growth and economic growth are worse.
Okay, so I just want to stop it right there for a second. So basically Andrew is asking, why did we not have this major market crash? Now, this is important because just a few weeks ago, this is all you could hear. The market's going to crash. Bond market's going to come crumbling down. It's going to be terrible. And all of these awful things were going to happen. And the point that we try to make in the very first workshop that we teach is how often the media is just plain wrong.
Right. Yeah.
When it comes down to all of their dire predictions about what markets are going to do going forward. So just check out the end of this because I think it's funny for that reason.
So I think it's critically important that we maintain monetary independence. Maybe the market believes that ultimately there will remain monetary independence, that nobody would go mess with a good thing that we have had. Or maybe they think that conditions are going to make clear that the people calling the shots are the FOMC and not anyone else.
Yeah. Rarely does, the worst case scenario ever come to pass. A lot of hand wringing. I mean, we're in the media, so we got to do these things. But
Isn't that funny?
Joe Kernan, right? Yeah.
Joe Kernan is awesome. I mean, that point that he's, we're in the media. We gotta scare people.
Yeah. So I think we differ a little bit on this, which may make for some fun conversations.
Oh,
but
yeah, go for it.
This is my opinion, right? Because we don't forecast or predict. But I think one of the reasons that you didn't see this crash in the market with this debate over Fed independence is I just think it's a false debate. I think really the idea that the Fed and the government are truly independent of each other is just ludicrous. Meaning there may be no direct tie. It's not even like the post office that's sort of government, sort of that kind of deal. But since it's been in existence, and you look at the Johnson administration, all these different things of, okay, the Fed's going to buy the bonds if the government prints the money. I mean, to me, it's almost to me a nod, wink, wink independence. I don't think the president calls the head of the Fed and says, okay, lower rates. I agree that, there's kind of that wall of separation.
If he had any control, they would have lowered rates a long time ago. So there's that independence.
But it's kind of like the speed limit is 70. Everybody goes 78. I just don't see them as separate ever, whether it's good times, bad times, Volcker, raising rates, I think they work hand in hand.
Well, he basically put the nail in the coffin for Carter administration when he raised interest rates, because then the economy was basically put on the brakes were put on the economy, and that caused all the problems that back then. Then you had during Johnson, you had that backing up against the wall and then pushing for lowering interest rates before the election, and then you had the Nixon, same thing, and then interest rates were lowered, and a lot of people look at the problems that we ran into 73, 74, and as being as a result of caving to do that. So, so there has been an independence in that. Is there any kind of it's appointed positions, so you get people that believe in what you believe. So there is, I think both are right. I think it's kind of
it's. I guess my point is I don't think it's that big of a change if a president is trying to influence the Fed versus they're not trying to influence the Fed. I just think it's not that. It's not dramatic of a policy shift.
But and I think what is funny about this is just listening to them just say,
"Oh yeah,
we were out there scaring people, and none of this stuff came to pass. Why didn't it come to pass?" And it is because there really isn't this. There isn't this push to have this out-and-out control, because it can be misused, to actually affect elections. And I don't think that's going to happen. I don't think people stand for it.
Yeah.
I don't think that would happen.
I think the best part of Goolsby's quote, though, was when he said it's, basically foolhardy to try to outguess the market.
Yeah, I think that is a good point.
That's
like
the
us.
gold nugget there.
Yeah, sounds like us, for sure. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.